Hi, everyone. Thanks so much for joining. My name is Denise Loria. I'm the Special Projects Manager at AFC. Today, we're going to be bringing you a webinar that's in collaboration with our legal advisory member, Davis Wright Tremaine. And we're going to be talking about to CFPB or not to CFPB and the regulatory developments happening in 2026. We have a great panel lined up for you. Just a few housekeeping notes. This will be 1 hour. It will also be recorded. So if you have to drop, we'll be posting it on our website and including in our weekly wrap that will be going out on Friday. If you guys have any questions, feel free to use the Q&A feature or feel free to drop them in the chat. We will be monitoring them, and if we have time, we'll be sure to get to them. And so without further ado, I'm going to pass it over to Melissa at DWT for an introduction. Enjoy.
Thanks, Denise. We have a lot to cover today, and I have an esteemed panel with me, but I think it would be helpful for us to just level set with our perspectives. And so I'm Melissa Alguiderizi. I'm a partner primarily in the DC office. I am also a New York barred attorney, starting as a litigator in New York. I was also in-house at Citigroup with managing litigation, compliance, and product development for consumer products and services, state licensed and federally regulated. And then really important to this discussion, I was 8 years at the CFPB in the Office of Enforcement, working with some others on this call. And so this is what we're talking about. Where is the CFPB now and why does it matter? And so I'm going to turn to my DWT colleague and former CFPB colleague, Eric Goldberg, for the next introduction.
Thank you, Melissa. It's great to be here and part of this sort of interesting discussion. As Melissa mentioned, I'm a partner here at Davis Wright Tremaine in our Seattle office. I left the CFPB in 2018. I've been in private practice working with fintechs, banks, and sort of other consumer finance companies on a range of issues, including earned wage access, buy now, pay later, card issuance, payment accounts, lending. So lots to talk about in this subject. So looking forward to getting into it with everyone.
Let's go to Nat. Let's finish the CFPB, folks.
Thanks, Melissa, and thank you, AFC, for having me. Exciting topic, perhaps a little passionate for me, as I left the CFPB just a month ago, where I worked for about 14 years, helping stand up the Office of Consumer Response. I led a 50-year review of consumer financial protection law, and I worked a fair amount in standing up the operational side of our competition and innovation team. Now I am at the Alliance for Innovative Regulations, where I am the Chief Development and Impact Officer for the Americas.
And Tim?
Hey, everybody. This is Timothy Lee. I'm the CEO, co-founders of Lend API. We provide software services for banks and credit unions and retailers to do embedded finance. Been around for 2 years, VC backed. Today I'm in New York, but usually I'm in Orange County, Southern California. Happy to be here. Thanks.
And last but not least, Matt Pierce.
Thanks for having me here today. I'm Matt Pierce. I'm the founder and CEO of Immediate. We are a earned wage access company based out of Birmingham and Atlanta. We work with about 625 companies across the U.S. and all 50 states, and strategically align with financial institutions and with payroll companies to distribute to businesses who then offer this benefit to their teams. And excited to be a part of this conversation today and looking forward to it.
All right, so we're going to start with sort of framing our to CFPB or not CFPB question by letting everybody know where we are with the CFPB. And so you may or may not know that the CFPB is unionized, and so the National Treasury Employees Union filed a suit against the acting director, Russ Vought, in February of 2025 to try to stop some of the actions to basically shut down the CFPB, or at least that's the claim. And so in the DC circuit, there's been litigation since February 9th, 2025, and to avoid the very onerous back and forth, where we are right now is that the CFPB has a hearing in February 24th, 2026, before the DC Circuit. There's going to be an en banc hearing, that's an entire panel of the court, to talk about some of the issues raised by the NTEU. In the interim, the CFPB had been talking about publicly that they had funding issues and may be closing by the end of 2025. So in December, there was a lot of us in the industry and both inside the CFPB and outside, I guess, trying to figure out whether or not there would be an agency starting in 2026. The court in DC issued an order saying that if the CFPB didn't ask for more funding from the Fed, which is part of the dispute in the case, that they would be in violation of a standing order of the court. And so January 9th, Director Vaught filed a notice with an attached letter showing that he asked for $145 million from the Fed, which was estimated to get it operating through March 31st, 2026. And so that has had impacts on a lot of different activity at the CFPB, including rulemaking that we'll talk about. From what I understand, that is an estimate, $145 million through March 31st. And as Nat is an example of, and others at the CFPB, the attrition at the CFPB has been significant. And so we're talking about a very trimmed down agency, and that money might last longer than March 31st if additional staffing decreases. And so that is where we are. And in effect, the CFPB is very diminished in its capabilities because of staffing issues. And it is not the 1,400 RIFs that had been contemplated in the spring, but the number of people actively working at the CFPB is very diminished at this time. And so my first question is the question of the title, and I go to each of the panelists to ask, how does this impact you and your practice and your company? So Eric, I'm going to start with you on the private practice scene.
Yeah, thank you, Melissa. I think, obviously everything that's swirling around the CFPB has huge impact to lots of people, all the employees, and lots of the agenda of the Bureau going forward. But what we tell our clients, what I've been telling our clients at least, is you don't need to react to every single headline about this lawsuit and the ebbs and flows of it. The most important thing to keep in mind is that, with some exceptions that I'll talk about, all the laws are still on the books. The laws that the CFPB enforces, the various enumerated consumer finance laws, they all predate the CFPB. And almost all of them, and there's some debate about this, but almost all of them are enforceable by other entities, whether it's the FTC or the prudential bank regulators, if you're regulated by one of those. And in a lot of cases, states have analogous laws. So for example, this morning, there was an op-ed in the Wall Street Journal from the acting director of the Bureau, basically saying that they're ending enforcement of disparate impact violations of ECOA. A number of states have ECOA-like laws on the books, and they're going to continue to enforce those laws. So I think when we've discussed that with clients so far, I don't think many lending clients are going to change their activities in any significant way because of an op-ed in the Wall Street Journal from the acting director, because ECOA is still on the books and all these other state laws are on the books and can be enforced by a range of folks. The same is true with respect to UDAP. So a lot of the debate about the Bureau since its earliest days were the scope of its UDAP authority, what does abusiveness mean, et cetera. But most states have some form of unfair competition or UDAP type laws, and all those laws, again, remain on the books and can be enforced by state attorneys general, state financial regulators, and others. And if you're going to adjust to react to the CFPB's diminished authority or diminished activity, you've got to keep in mind that all these other laws remain in place. And even with the stuff that the CFPB has done since the change of administrations about a year ago, some of it, the impact of that is still really unclear. So for example, the payday loan rule that went into effect last spring, the CFPB issued an advisory saying, we're not going to prioritize enforcement or supervision actions with regard to the payday lending rule, but that doesn't mean the law is not on the books. And so I think a lot of clients have had to think carefully about what does that mean with respect to compliance. It's not so easy if you're a company just to ignore law that's been promulgated or regulation that's been promulgated. For example, you may have contractual obligations to investors, to business partners to comply with the law, and that's a law that remains on the books. Or if you're a public company, you could have securities violations to consider if you're not complying with an active regulation. And that's an example, I think, also the payday rule of just some of the chaos at the Bureau. They said last spring that they were going to consider a proposed rule. We haven't seen anything else from the Bureau on that. It's been almost a year. And so we're going to talk about some of the other rulemaking and policymaking activities at the Bureau, but there's a lot like payday that's still very much up in the air. I had some more I was going to get to, but I think in the interest of time, Melissa, we go to the next person.
Well, I'd like to move to Tim as a sort of newer company that's trying to enter this embedded payment space. How is this impacting you?
Yeah, so yeah, embedded payments, embedded finance is what we do, and we certainly work with a lot of credit unions and banks. I guess CFPB has been around for what, 15 years, since 2015-ish. I think it's all the regulatory stuff is all beaten into people's heads that runs these banks and credit unions. So I don't think anything is changing there. But we also work with financial services companies, right? So they will talk about or have sensitivity with all of the lawsuits that were dropped by CFPB against just about everybody except for one or two. So I think that gives them a sense of comfort, which I have to constantly remind them, just like what Eric said, UDAP, FCRA, ECOA, all this stuff still stands, and you have all these state regulators that are, constantly examining you guys on a on an annual basis. So none of that stuff goes away. But then we also work with, you know, Target, Sunglasses Hut, all these big retail brands that build their own BNPL experience, and they will have no clue what's going on. So to them, CFPB, yes, we got to do something, but we have to sort of be that concierge from time to time to let them know, hey, it's not just collecting 12 payments. There is all sorts of consents, EFTA, consent to pull credit, all that language is reviewed by a law firm, and et cetera, et cetera. So there's a whole bunch of folks that are building their own financing arm that have, one, no place to do, they shouldn't be doing it, or needs a quick education or longer term education on how financial services works in the United States. But you talk to these banks, we're still going to follow all the letters of the law. You talk to these financial services companies are rubbing their hands together. Yes, all the lawsuits are dropped, and then you talk to these big retailers are just getting into it, and I don't think they know what's coming down the pike. So it's a brand new education for those guys. I'll defer the rest of my time to other people.
Yeah, no, I think that's really helpful. And I think, Nat, when we had our prep session, you talked about how regulation impacts innovation, and that would be really good to talk to here, I think.
Yeah, I think we're at a unique point in the evolution of the financial industry. AI, digital assets, bank fintech partnerships, what have you. And there's a lot our leaders can do to promote American competitiveness, national security by fostering regulatory re-engineering, regulator modernization. But really, to pursue these goals, the regulatory bodies really need to be deprioritized. And this is particularly true for CFPB, where dramatic and rapid changes from administration to administration are costly to industry, creates uncertainty for consumers. And sadly, I think the goal of trustworthy markets, a vibrant financial services industry, prosperous consumers, it's not controversial. Both sides of the aisle and industry support good, clear consumer protection regulation. A major debate surrounding, my time at the Bureau, or throughout my time at the Bureau, was what good consumer protection looks like. Some leaders sought to maximize consumer protection by stopping bad actors. This might manifest in, say, heavy supervision and enforcement actions, intending to root out maybe harmful actors or level the playing field. Other leaders sought to maximize consumer protection by increasing consumer choice and inclusion. And this might be seen through actions that encourage regulatory clarity and reducing regulatory burden. And no matter where you stand on the spectrum, consistency and clear rules of the road are imperative for creating an environment that fosters innovation. And ultimately, innovation spurs competition, and competition leads to lower prices and higher quality financial products and services. So, so I think we need clear rules of the road, and we need kind of to stop the whiplash.
So Matt, why don't you close it out on this to CFPB or not CFPB?
Well, it's a great segue from what Nat just shared. I mean, when I think back to we launched our first clients at Immediate in late 2019. And if I think back, probably the first 2 or 3 years, we were, I think our average client size was 350 to 400 employees. And this was just not really something on their radar. Fast forward to last year, our average new client in 2025, and I know this number exactly because I just sent out an end of year investor report yesterday. I wouldn't normally know the exact number, but it was 2,988 employees was our average new customer size last year. As you would imagine, when you get into this mid-market and enterprise, there's going to be larger legal teams. There's going to be, in some cases, regulatory and compliance that you're going through as you're going through a process to onboard a new client. And so the CFPB and some of the back and forth and what has happened specifically for us, and there have been a handful of advisory opinions. There was a proposed opinion in 2024 that kind of pumped the brakes on a couple of things that had happened in the previous administration, and then there was a new advisory opinion. I know that Eric, you and Melissa may touch on here shortly from an EWA perspective. That was just issued in December. And so there has been some back and forth, right? But when you get into these larger, more sophisticated organizations, these are things that start to come up and start to slow down like sales processes, right? And so when you think about companies like ours and Tim's, as we're getting going and we're trying to move quickly, and in most cases, as venture-backed companies, you're burning cash early in your cycle. Every month counts. And so it starts to come into play of we want to make sure that we're providing for us at Immediate a responsible earned wage access solution to as many employees as possible. The case there, of course, would be the larger the employer, the more people we can impact. And so we can move through a sales process pretty quickly, but when we get to a spot where we get to a legal team and they go, well, what's the CFPB going to do, right? And I'll share that we have 3 companies, all of which are tens of thousands of employees that we've gotten all the way to legal, one of which we spent the majority of 2024 in an RFP process with, where we won the RFP process, and then it gets to legal, and they said, well, until the CFPB has come out with what we feel like is a approved advisory opinion that says that EWA is not a loan, we're not going to sign this contract. And so I think kind of to the point that you all have made along the way, regulation is a good thing. We do need to have guardrails on the industry. I think where we struggle as an earlier stage business, I mean, we've been around for 6 years now, but as we continue to try to grow rapidly and impact as many lives as possible, we just need to have some clarification, right? And feel that there's solid ground that we can stand on and feel confident when we go in and sit down with large enterprise organizations, large strategic partners, or in many cases, financial institutions that we also partner with to say, we feel really good about where we stand with the CFPB and where our product kind of plays and fits in the market.
That's really helpful. And, I used to call that when I was in-house stress paralysis, right? Who wants to invest in something, in a project that may be moved? And so let's go to earned wage access, because that's one of the substantive topics we want to cover. And I will hand it over to Eric, who we had a byline together on an article that I think he's going to let everybody know about.
Sorry about that. Yeah, I'm going to a little bit more detail on what Matt was just talking about, but I think it's important to set the context. Before, when we're talking about the CFPB writ large, there's a lot that's happened. The news is sort of changing every day. And what I would say is be hyper-focused on the news that is relevant to your product. So in some products, there's been some pretty substantial changes. So I'll talk about EWA, but buy now, pay later. There was a rule last year that said, or 2 years ago, that said that said buy now, pay later companies had to comply with certain provisions of Regulation Z applicable to credit cards. That was a huge amount of change for that industry. And then the current CFPB leadership pulled that back, and that is a tangible change. But in other industries or other products, there hasn't been the same sort of tangible change. And so really focus on what has or has not happened. And so I think that leads us to EWA, where Matt noted there's been, I guess now we're on our third different interpretation of the law from the EWA, from the CFPB regarding EWA. So they issued an advisory opinion before the end of 2025, so about a month ago, right before Christmas, that at a very high level basically caused the CFPB to revert to its 2020 interpretation, in which the CFPB issued an advisory opinion then under the prior Trump administration, saying that an EWA program with a very narrow set of attributes that probably very few, if any, products actually met, those specific products were not considered loans under the Truth in Lending Act, primarily because those products did not involve an extension of credit and did not involve a finance charge. When leadership switched at the CFPB, the new leadership, Rohit Chopra, very early on said he didn't like that advisory opinion, but it wasn't until the very end of his term at the Bureau last year where they issued a proposed interpretation that would have reversed all of that. And then just last month, the current leadership of the CFPB reversed it again, so eliminated the proposed interpretation. So Melissa and I don't have to sit around and advise clients on what in the world a proposed interpretation means and what weight it might have. What we do have is an actual advisory opinion in which the Bureau basically restated what it had said in 2020 with, important to me, is a new and I think much stronger reasoning as to why earned wage access is not credit and why the fees, optional fees that a lot of EWA companies charge are not finance charges. What's important to keep in mind, and the CFPB sort of says this throughout the document, is they were not writing here on a clean slate. The 2020 document talked about specific types of employer integrated earned wage access. And because the Bureau thought they were refreshing that earlier opinion, it seems that the current opinion sort of evolved out of that, and to the point where it doesn't cover every type of earned wage access that exists in the market, particularly certain types of direct-to-consumer products. And the Bureau says we're not saying in this advisory opinion that other products not mentioned in the advisory opinion are not credit. There's about 4 negatives in that sentence. So let me try to say that again. There's certain products that are covered by the 2025 order, and there's certain products that are not covered. And the Bureau says about those products that are not covered, they're not addressed, that they're not saying those products are subject to TILA. In fact, they invite industry to come in and seek an approval order about other models. And we can maybe talk about that invitation at the end and what it says about the future of the Bureau and how it might treat this. But just keep in mind, if you're offering one of those products that's not expressly addressed in the advisory opinion, that doesn't mean the Bureau is slamming the door on whether you are or are not covered to TILA going forward. And just to go into a little bit of detail, the Bureau says that covered EWA products, or products that are not subject to the Truth in Lending Act and Regulation Z, are those earned wage products that rely on payroll data to determine transaction amounts and use a payroll deduction to recoup each earned wage advance. And so it excludes products that do not have access to payroll data or that do debit consumer bank accounts. And then it says that covered EWA is not credit because consumers do not incur a liability or obligation to which they have a right to defer payment. And that's sort of the central issue we've been debating on EWA probably over a decade now, as to whether a non-recourse earned wage advance actually creates a debt. I would tell you, if you look at any state law, the answer is almost certainly no. Notwithstanding that, the debate sort of continues, and this is the CFPB attempt to sort of try to end some of that debate, at least as credit is interpreted under federal law. And then the second part of that is the Bureau said that the fees typically charged in an earned wage access program, whether it's a fee to expedite a delivery of funds or it's an optional tip, that in most circumstances, those fees are probably not finance charges. But it notes sort of interestingly that it really depends on how the product is marketed. So they don't give a ton of detailed examples, but we've been working with clients since that come out to understand that you need to make clear in your marketing that the fees are optional and that you can access a version of the product without paying that fee. And then finally, they said, and this is applicable to people who offer all ranges of products, they reinforced the exception in Regulation Z for periodic fees. So whether that's monthly or annual fees, there's an exception to the definition of finance charge for annual fees that was created back in the day for fancy credit cards. A lot of fintechs have now applied that exception to monthly fees they charge for their product. Under the prior administration of the Bureau, there was some indication that they were trying to narrow that interpretation, but this advisory opinion restates that subscription fees are not finance charges. And I think that holds true sort of regardless of the product that you're offering. So I will stop there. Happy to go into more detail or answer other questions, Melissa, but I think probably we want to move on to discuss what all this means.
Yes, I think it's really helpful. And I'd love to hear next from Matt about what are some of the positive impacts. I may be going out of order from what we had before, so sorry for not giving you a heads up. But the impact to you as someone who is in this space seems particularly important.
It's certainly, I mean, Eric, you summarized a 27-page document in about 4 minutes very well. So and even pointed out a couple of things that I jotted down as notes. It is definitely helpful for us as an organization. And as I mentioned, like trying to unstick some stuck opportunities, right? But ultimately, what it really also means is because I do think it's important for us. I mean, we were fortunate at the time that we were building our initial product that it was around that 2019 advisory opinion, and so there were 8 bullets in there of what was considered a good solid employer integrated EWA solution, and we kind of used that as a little bit of a product roadmap, right? Give us some framework as to how we're going to do this and operate inside the confines of the regulatory landscape. And so it was encouraging to us to kind of go back to some of those things that we had already checked the box on and felt good about. Eric, you made a great point about being able to offer free options. I will share that we have multiple free options. I think we have 3 different free options. People can plan ahead and move into a bank account in 1 to 3 days through ACH. We have an immediate debit card they can move money onto, and we actually even have a gift card marketplace where they can go and move money into gift cards, all of which there are no transfer fees for. That being said, less than 10% of our transfers are free. And the reason being is because in most cases, what people are navigating is the peaks and valleys of income stream, right? And when we've got 70% of the U.S. workforce living paycheck to paycheck, when that paycheck hits on Friday, I've got to go pay my big bills, right? My rent, my utilities, my car. I'm going to go to the grocery store, all those things. And when we start getting closer and closer to the next payday, right, we're kind of down in the valley, right? Our bank accounts have started to dwindle, and we're looking for places to make ends meet. And if something unexpected happens, I'll tell you that our most popular use case is I'm standing at a gas pump. I swiped my bank issued debit card and I didn't have $100 in my account to do the hold for what I'm about to pay, right? And so that's a situation where they're willing to pay a $3.50 flat rate transaction fee because I need it now. If I don't do that, if I don't pay that, I'm not going to be able to make it to my job, in which case I may get terminated, right? And so, so while it is important for us to offer those free transactions, we see 9 out of 10 times people are willing to pay a small flat rate in order to access their pay when they need it the most. But all that to say is understanding the data and the usage of the typical earned wage access user is really what puts us in a place where we want to make sure we're providing the best service. And so the advisor opinion that came out in December really helped us do that. And so we've continued to make tweaks and adjustments. Our product team keeps a good eye on this, or I should say our compliance team keeps a good eye on it, who passes it over to our product team and makes sure that we're checking all the boxes and continuing to try to grow the business as best we can, kind of within the regulatory landscape that's there. So hopefully that's a little more helpful context around just EWA in general.
Yes, and I want to welcome here, Nat, from your current vantage point with your knowledge of having been at the CFPB, do you have any thoughts on this new advisory opinion and any kind of other clarifications that might be useful moving forward?
What also, I mean, Eric summarized it fantastically. The conversation comes down to whether the product falls within an existing regulatory framework namely TILA Reg Z, is it defined as credit? But I think the other part is, I think Congress is asking, does a new rule need to be promulgated? Um, and I'm going to say it sounds like there's bipartisan agreement, maybe not unanimous agreement, that EWA doesn't fit the traditional definition of credit. So I wouldn't be surprised to see congressional action create a new rule in the space of EWA. And there was a Representative Torres at a hearing the other day said, and I'm going to paraphrase, is EWA is neither good or bad, but it should be regulated so it doesn't become an issue. I think EWA is a great product. I think you see workers want it. It's just a personal opinion, not a professional one. But I like that idea that regulated so it doesn't become an issue. And the question is what issues might we be trying to avoid? And I'd say any scenario where a consumer cannot reasonably avoid decisions that harm their welfare, whether that be due to lack of competitive alternatives or deceitful or unfair practices. In light of this, I do think it's very important that EWA, at the very least, deserves its own classification and definition, or else it may begin to be marketed similarly, or payday loans may actually choose to market themselves like earned wage access, and that'll create consumer confusion. AIR, Alliance for Innovative Regulation, published a white paper on EWA that touches on this topic. I think it's a great read. It's on the website. And I'd add in that I think we're gonna need to see requirements, appropriate disclosures, such as, is there a free option to use a product? To touch on some of what Matt was discussing. Are there free options? Do we default to a fee-based option, or is there automatically an inclusion of a tip and a consumer isn't even aware that there's a free option? I think that sort of disclosure is really important. And since we're talking about innovation, or I certainly focus on innovation, I think the notion of dynamic disclosures would be a really fun discussion to have in this space. I think it would be a really neat tech sprint, but I don't want to go too far that way and talk about exactly what my work does. But I do think appropriate disclosures, and I think about having a specific category and a specific definition for EWA is important.
And so, Tim, I'm going to ask you a question just because something came to mind when you talked about the merchants piece of your portfolio. I have seen that some of this EWA pressure is coming from those merchants who have delivery drivers that they're using, some gig workers that are on that are related to them. Have you been seeing this new AO or EWA impacting your work?
Yeah, so first, we're not a pure play lender like Matt's company, or just an infrastructure company. So we are, hired by banks and credit unions to build this type of product. So they look at early wage access as something that's great, but they also look at all the regulatory pressures of all the ambiguity as something that they want to avoid. They're the most conservative type. So what they end up doing is that they will say, you know what, the payroll, reading into the payroll files is a great plus because reduces risk. Processing repayments from payroll records, that's a great thing as well. That reduces risk. So they basically morphed this EWA product into just a standard personal loans product, charging just a minimal amount of interest rate APR, by using that payroll rail to deduct repayments, or reading into the payroll file to kind of understands the employability of this person. So they're offering this product, a bank version of earning wage access, to their commercial clients. And these commercial clients have thousands of employees, like United Health, for example. So we see a version of this playing out. And so these banks are picking up the best part of a early wage access, framework, and making it into something that's in a already well understood regulatory infrastructure, which is just a standard personal loan, and using their license to offer this to their commercial clients almost as a HR portal, benefits offering. So that's what we've been seeing. So it's not pure early wage access, fees and convenient fees and monthly fees and all that stuff, but they turn into something like a personal loan, which they don't have to worry about too much about regulatory ambiguity, so to speak, going into this. But that's what we've been seeing. We haven't done a whole lot of gig workers, wage, that type of stuff, but we certainly see these standard, credit unions or banks that have these massive, they call them select employee groups or just essentially commercial clients, that they're coming to the banks and say, you know what, we want to create our own version of early wage access. We don't want them to take out payday loans and things like that. Can you create something for us? So we're the workers to sort of to help these banks to build out these programs. That's what we've been seeing.
And so to sort of tie the loop on this before we move on to our next topic, I think this product obviously goes across a lot of different types of companies, chartered banks, fintechs, platforms. But risks are not just regulatory. I think, Eric, you had some thoughts on some other risks that might be there to the market.
Yeah, and this is not particularly unique to EWA, but one thing we've really seen sort of a resurgence of, for lack of a better word, in the last year or so is actions by private litigants. So, back in my day at the Bureau, those of you know what I worked on there was a lot of effort to get rid of arbitration clauses so that, to allow class actions to be filed. That never went anywhere. But what we've seen is plaintiffs' lawyers now getting more creative in filing mass arbitrations and taking similar actions to sort of increase private litigation. And when you're in court, as we've seen from some of the rulings specific to EWA, court decisions can go any direction. And one thought is the impact of this advisory opinion, because I think the reasoning is particularly sound in it about how you interpret the terms debt and credit and finance charge in Regulation Z. Hopefully will have a significant impact on how courts going forward are going to interpret the Truth in Lending Act, the Military Lending Act, et cetera. But in the short run, one thing we've been helping clients with quite a bit lately is making sure that their arbitration clauses are robust and designed in a way to minimize things like mass arbitration. So I just wanted to sort of put in a note about that.
I think that's a really good note for all that's happening now, and sort of really talks about how the threat service of risk has just increased with the lack of regulatory oversight that we've talked about from the beginning.
And I just one more piece on that, Melissa, is I think a lot of folks who do consumer finance understand that they have an arbitration clause. They can typically block a consumer class action. And particularly in earned wage access, where the position is the product is not a loan, what we've seen some plaintiffs' lawyers do is find service members who use the product to bring claims under the Military Lending Act. When service members are using certain lending products, you're not allowed to impose an arbitration clause on them. So that's been an interesting way that some plaintiffs' lawyers have been trying to get early decisions from courts on the applicability of state lending law, but also the Truth in Lending Act, which uses the same definition of credit as the Military Lending Act. Sorry, that was a bit of a detour.
Yeah, no, I think it's a really important point because, as someone who sort of worked during the last days of state regulated lenders getting really pummeled by private litigation, you create law that way. And when there is no regulator up top really doing the interpretation, it becomes an on the ground effort. And I think that's important to note. So we're going to move right now to 1033 open banking because it's another hot topic that the CFPB is supposed to be managing right now. And there's some back and forth in that world as well. And so this is something that was, 1033 is a section in the Consumer Financial Protection Act, which was passed in 2010. And the CFPB did not issue a formal final rule till 2024. So that took a long time. There are many reasons for that. It's because the ecosystem in which this rule impacts, it's so broad and so deep. And so what are the basics? I'm not going to go through a whole 1033 analysis here, but basically, it's called open banking. What it really is consumer access, rights to access their own data. That's what the 1033 rule says. And data providers shall provide that data to consumers. And then it was dependent upon the regulations promulgated by the CFPB. In October of 2024, a final rule that was issued after 11,000 comments during the rulemaking period. The same day, October 22nd, the Kentucky Bankers Association, Forest Bank, and BPI, Bank Policy Institute, filed a lawsuit in Kentucky to eliminate that rule, to say it had exceeded its authority, the CFPB, to write that rule. And so it's been in litigation ever since. And what does that mean? It means that consumer permission access to data that had been sort of contracted between data providers, largely banks, and data users, third-party data users, largely fintechs, over the course of years, had some guardrails that were going to be set with an initial compliance date of April 1st, 2026. Now that's up in the air. And that has really upended a lot of both contractual agreements that are going through, and also just how is this ecosystem supposed to work. The 1033/2024 rule really only focused on payments markets, so credit cards and Reg E accounts. And so there's a lot of information that was part of that scope, including consumer initiation data for payments, which was something that was a big issue. So there's been a lot of back and forth. The lawsuit has gone through a lot of different iterations, and the CFPB has taken opposite positions in that same litigation. Most currently, they had not defended it and then started defending it, and then had told the court essentially that we're going to write a new rule. In August of 2025, they announced a proposal for new rulemaking. It was basically 34 questions-ish of, what do we think we want to do with this rule? And looking at 4 key categories on what were defined as issues on the rule: who may act as a consumer authorized recipient of the financial data, who can be an authorized data user, the cost of data access, the issue of fees, because the original rule banned the use of the charging of fees for access to data, which was a huge issue. Managing information risks. Obviously, this kind of data, consumer permission data flow would have a lot of information and security risks, and then safeguarding privacy. What has happened since is that the CFPB had been talking about closing at the end of December 2025, call back to the DC Circuit case. It all weaves together, these court cases. And so they had talked about the fact that because their funding was unconstitutional, they would run out of money. What did that mean for the 14,000 comments that were received from the ANPR from August? Well, the CFPB had said they were going to do an interim final rule, which would not have been a final rule, not necessarily going through all of the comments, and they were going to issue it by the end of the calendar year. There was a lot of back and forth. The DC court issued an order saying that they would consider it to be a violation of the court's order if the CFPB stopped working because of funding issues, because that was still to be determined by the court. And in fact, the DC Circuit is supposed to hear the NTEU's case in that previously referenced DC case at February 24th. So shutting the doors December 31st was not going to comply with the court's rules. And January 9th, in kind of big news, Acting Director Russ Vought actually asked the Fed for $145 million. The estimate was that it was going to go till March 31st. We'll see, as I said before, whether or not that goes past that because of the funding. For 1033, what does that mean? It means that there's been a pivot that we understand. It's been reported now in Bloomberg, but those of us who work on 1033 matters have been aware that this CFPB is now going to try to do a full final rule. Not sure what that's going to be. It should be informed by the 14,000 comments and the issues in the ANPR. But at a very big level, it impacts a lot of different parts of an ecosystem that's growing. the use of APIs, which is what we're talking about for this data sharing regime. It's plugging in directly to the data sources and providing hopefully accurate and secure data to end users like fintechs is something that's going to be useful not just for fiat payments products, but for crypto payments products, for a lot of even maybe AI generated agentic commerce that we've been talking about. So this idea is going to underpin innovation moving forward. And the back and forth on this, I know advising clients has been very difficult to navigate. The stress paralysis around the kinds of infrastructure development you have to do when you're contemplating this kind of change, it's really tough to manage. And so that I've set the stage for everybody on where we are. Who knows? Hopefully, I was hoping to get a usually when I do these things, someone files something the morning of. It didn't happen today, but we will probably get a filing, at least in the Forced case, in the Kentucky case, saying that the rule is going to go to a full rulemaking instead of interim final rule, but who knows? So I'm going to go to Tim first
Sure.
because API use seems like something that's right in the sweet spot for
It's in our
you.
name, Len API. I'm glad I'm just an engineer. My God. All that narrative, Melissa, it's like a TV episode. So, you know, for my personal opinion about this is that I don't think anybody will argue against not letting consumers having their data. I think early on, the JP Morgan Chases of the world or Capital Ones of the world will say, we can't let this data out because security, cyber, all that stuff. I think they dropped that argument, and now they're saying that there's a cost to all of this, right? The infrastructure they build inside the banks are really for normal downloading a statement here and there, have people log in, apply for a checking accounts and whatnot, and now all of a sudden they are forced to open the floodgate for the Plaids of the world to access. Who's going to pay for all these CPU cycles, right? Jamie Dimon openly said we love Plaid, but Plaid, you got to pay us, a lot of money for each access. So the argument is who's paying for it. But ultimately, all of this cost is going to force down to the lenders, the fintechs, and the consumers potentially, but the law says otherwise. So in my shop, it definitely forced a lot of innovation. I'll tell you what it is. We're back to scanning bank statements again. So where the fintechs are saying, hey, look, the prices are going up, but the consumers are still sending us bank statements. Can you develop software, of course, AI generated, to scan documents? So we spend a couple of months building the AI tool to scan any numbers of bank statements, driver license, P&Ls, income statements, all that stuff. So you can pump right in. And the output of all these information looks just like Plaid data. And we can still work with all the cash flow analytics people, God bless those guys, like Pave or Prism, to still extract all of the nice, underwriting algorithms or attributes based on bank data. So we're back to the stone age of scanning documents, but tech nowadays are good enough to we can extract all of the banking information just like Plaid would within the couple hundred milliseconds. So we're back to that now of the fear of the banks and fintechs are saying that, hey, look, the cost going to run up. Jamie is going to make Plaid pay. Plaid's going to make us pay. Let's go scan documents again. That's what we see.
Wow, that's something. So Matt, what do you think for EWA use? How does this impact you guys?
It's interesting today. Not a ton of impact, I think, on primarily B2B earned wage access solution providers, right? I think this is where there's direct to consumer and future iterations as we look at roadmap and think about the future of being able to. I know there was a mention earlier. I think Eric, you said it around. No, I'm sorry, Nat, you said it around like dynamic limits and being able to access different, as you continue to build confidence within with a user to be able to give them access to more and more. By utilizing some of the open banking 1033, I think there's some confidence that can be built specifically around direct to consumer EWA. It's just not something that we do a ton of. We have some pretty strong financial institution relationships where I do feel like this will start to impact those, but primarily around access to data, shortening cycles to build confidence in who the users are and what their background is, their financial background, understanding some of their compensation data, things of that nature, which is ultimately going to allow us to provide a better service. So I agree with everything Tim has shared. There's and I think it just ties in really well to this conversation, right? There's this pendulum that can swing back and forth, and having a body that can step in and say this is what makes the most sense, where we can try to keep that pendulum from swinging too far one way or the other, kind of keeps those guardrails pretty tight. So I'd say that's probably how it best impacts earned wage access. Definitely future state today, more so for organizations that are going direct to consumer.
So now we are hearing some, sort of retrograde on technology because of the lack of clarity here. Is there something that, your organization might be able to do to mitigate and balance that amongst stakeholders, or do you have any guidance maybe?
Absolutely. And I want to hit that, and I hate to bury what we do, but I do want to say kind of this issue that Tim was mentioning. It illustrates a problem law professor Michael Heller calls the anti-commons. And where you see an anti-commons problem exist, government intervention will maximize market efficiencies. I just think that's a really important principle for our lawmakers and regulators to really think about, is the anti-commons and how this might be happening in this space. Now, to your question, I'm sorry to sidetrack there. Well, AIR has shaped the global conversation on regulatory modernization, and this is a regulatory modernization discussion. We work to ensure oversight is technology-enabled, data-driven, and future-proof. We use a variety of innovation tools to help regulators, financial institutions kind of navigate our evolving financial services space. Ultimately, we want to create a more resilient, transparent, and fair financial system. So one thing I would say is that, that's a lot. What does it mean? And I'll back out. I'll say our regulatory framework was drafted during the industrial age. And as technology has led to innovations in consumer financial products and services, we bolted on new rules and regulations to fit the existing framework. I mean, we've even talked about that with EWA right now. And this creates a tendency to lead to an environment that lacks regulatory clarity. And I think as a non-member, nonprofit organization, AIR has the unique ability to act as a super convener that brings together all stakeholders and equities, including the regulator, to examine how market evolutions intersect with regulations and how to work towards improved regulatory efficiency in an unbiased forum. And I think that's our secret sauce, and I think that's what we bring to the table. And one other thing that I'm going to say in the context of 1033, concepts like fee prohibitions and CFPB's role in establishing a standard-setting organization, liabilities, definitions of consumers and third parties, they're likely all going to evolve and be addressed. But we're still going to see topics like fraud and other financial crimes, third-party vendor management, liabilities, privacy, security are going to be topics that can't and will not be resolved in 1033. And I think we're going to still see organizations reaching out to us and asking, hey, let's talk about how we can evolve the regulatory ecosystem to be more efficient, to embrace ever-evolving economy and financial industry sector. And the last thing I'm going to say is another topic that we need to address in the same breath, and this is where we really come in, our special sauce, is how will CFPB or any regulator satisfy its statutory mandate of supervision when so many people have left these organizations? Similar to thinking about our regulatory framework, that re-engineering it, our regulatory tools and techniques were conceived in analog as well. There's a really couple of years ago, FDIC said I think they spent 400,000 hours just doing data entry into spreadsheets. That's wild. And so when you think about the regulators' technology and their ability to regulate, particularly when we've lost so many people, we really need to revisit something like the Futures Act, a bill that would require the financial regulators to look at their technology and say, how prepared are we to really confront this evolving ecosystem where technology is so much greater than when most of these rules were really conceived. I think we need to look at how soup tech can lower the cost of compliance for industry. And none of this is intended to be a criticism of regulators. They have an increasingly difficult job. They are in a very difficult environment currently. So I intend this really to be a comment, a plea to help the regulators better protect consumers, engage with industry, and fortify the American economy. And I'd say AIR has engaged in this journey with regulators and governments around the globe. And we continue to look forward to doing so through 1033 and in other areas where we need to see improvements that'll help industry and will help the regulator and ultimately the consumer.
Okay, so thank you, Nat. I think we're about 4 minutes out to the end. And so we've run through everything, and it, as we expected, is going to go over unless we bring it home. And so one of the things that we got in the registration is a question that I think we can use to close out. What are the regulatory and supervisory risks that are most likely to have an impact on fintechs in 12 to 24 months? I'm happy to just give a little bit of a soup of what everyone else has said and pull from it. I think the issue is that the threat service for regulatory and private litigation risk has increased. And so you've gone down, and maybe your federal regulatory risk has gone down, but the undercard of 50 states is now on your top. And those are states that have less resources than the federal government. They're going to be harder to navigate, and they'll have 50 different ideas about how to do it. And so that, I think, is something to really think about. But I try to leave with a hopeful note, and the hopeful note is you have the ability to choose your own destiny in this. And I think, going back to what Eric said, the laws that are on the books, the way you do a sustainable, scalable business in a compliant way for your end users is the way to go. If you know you can do this today, then you should be able to do it tomorrow and the next day. And so I'm going to let Tim and Matt sort of in that order. I think we have 2 minutes.
Get good law, get a good lawyer, law firm, get good consultation. It's really complicated to navigate through this whole system, especially in the US. I tell our big retail friends, you might be Target, you might be Luxottica, you need counsel. We can help you as much as we can on the technology side, but to get into lending, whether you charge 0% APR or whatever that might be, you need a good understanding of what's coming down the pike, 1033, all that involved. So I think all of us should do a better job educating some of these new folks that are coming into the financing space that aren't credit unions and banks and lenders. That'll be my call to action. Thank you.
And Melissa, I think you put a bow on it really well. I don't have a whole lot more to add than that. I mean, there are roughly 15 states right now who have passed EWA legislation, and Nat mentioned earlier a bipartisan national EWA bill that may be coming up here in the next couple of months, and we're all for that. Going state by state is a difficult thing to do, and so I do think the next couple of years, from a regulatory perspective, are going to be a challenge, but it's definitely something that for any leaders out there that are listening, this is something you've got to stay focused on, and joining events like this where you can hear from a lot of smart people about what they're doing and how they're navigating is a great way to educate yourself. So I thought you did a great job and really enjoyed being a part of this panel.
Yeah, thank you all. It was really fun. And I think that's pretty much it. Obviously, we're all available to answer questions. Well, maybe not the business folks, but Eric and I are. I hope everyone stays warm in the appropriate areas where it is not, and talk soon.